Okay, welcome to a new video in our new series for the training videos. Today we're going to be looking at mostly divergences and an overview of the indicators, and we're really just going to break it down to see how you can apply these to a chart. Okay, so on the first chart here, we're looking at Bitcoin on the 1 week chart. Now, the important thing to remember here is that if you use higher time frame charts, you're looking for bigger, longer term moves. So I like to start on the higher time frames first. I want to see what the overall trend is looking like on the higher time frames before I start diving into the smaller time frames when I look for a trade or an opportunity. So on the Bitcoin chart here, you can see previously on the top, we were watching these divergences back in 2021. The move here that started the whole downtrend was this bearish divergence that you can see. Now in the beginning, divergences will be a little tricky to spot. So we're going to try to break it down for you just a little easier so you can understand what the point of a divergence is, or what the main feature of a divergence is, I should say. So the key thing that you're looking for is that when the price starts to make a high, right, we got a lower high than this high, right, lower high, higher high. If you mark the top of the price action, then down here on the indicators, you're also marking the tops of the indicators, right? So these are the swing highs. Okay, and on the histogram, you got your swing high and your swing high. Down on the RSI, you have your swing highs, your swing high, right? If you're looking for bullish divergences, then you're measuring the bottoms of the swings, okay? So this would be a swing low. This would be another swing low. Over here is another swing low, right? It's the bottom of the price action. If you're looking for the bearish divergences, you're looking at the tops of the price action. So if you're comparing a divergence from the price action to the indicators, you want to make sure that you're not mixing by using swing lows. And then on the indicators, you're not trying to look for a swing high, right? You're always measuring the lows and then comparing to the lows. So here you have this is a higher low than this low. So you come down to the indicators down here on the RSI. And there's a disagreement, and that's basically what a divergence is. It's a disagreement between the price action and the indicators. So on the RSI, you have a lower low, and on the price action, you have a low that's higher than this low. So this is a higher low, this one's a lower low, and then on the next swing over, the RSI is printed a higher low. On the price action, it's still made a lower low. I'm going to zoom this up so you can see it a little better. Okay, and on the top over here, you have a high. This is a lower high than this high. So this would be a bearish divergence. So you have a lower high here and a higher high there on the price. And you come down to the indicators. This is the MACD with the lines. You have a higher high here and a lower high. So they disagree. Okay, so this one's saying that it should be a higher high on the price action. The indicator is showing that it's a lower high. That's what makes a divergence. On the histogram, you have the same idea. You have a high here. This high over here is lower than this high, right? So again, it's a disagreement between these two top swings on the histogram and on the MACD and on the RSI down here. So the RSI did the same thing. You had a higher high than this high. This is a high and a lower high in the RSI. You have a low and a higher high on the price action. As you can see, if you have a multiple indicators that are showing the same divergence on the same swings, right? You got it on the MACD, you got it on the histogram, you have it on the RSI, price action is saying something completely differently. So what happened, right? The price came all the way down, and that was the bear market until we got down to these lows. So on the yellow line, you have a higher low and then a lower low. On the histogram, you have a low that came in first and then a higher low that came in next, right? So this would be a bullish divergence because you're marking the bottoms of the price action and you're marking the bottoms of the indicators. So again, because we're using a weekly chart, these take a little longer to play out. They may not be as instantaneous. In some cases, they can play out fairly quickly, but this was a multi-month downtrend, right? It lasted about a year and a bit. So over here, we're starting to see the momentum shift, and that's basically what the histogram is. It's more so the momentum is changing, right? The momentum is disagreeing with what the price action said. So you have a low and then a higher low, and you have a low and a lower low. So the histogram the price action disagree. And then once you got to the next swing, you have a low here and then a lower low here, but the RSI disagrees with this price action, right? So you got a lower low, and then it's printed a higher low where it said it should have been a lower low on the price action. After this divergence was printed on the RSI, you can see we got a different move, right? It didn't continue the downtrend. We started getting moves to the upside here. So this is your divergence playing out. That's your bullish divergence if you're marking the bottoms. Then we got a trend change. Okay, so longer time frames or higher time frames, you're looking for a change in the trend. And if you use it on a weekly chart or a monthly chart, maybe a 3-day chart as well, you're looking for longer, consistent moves, right, that are going to last longer. So we're going to take a look at the next chart. All right, so this is SHIB. And on the 2-day chart on the left, I've highlighted this little green box. I've also highlighted this divergence. This divergence here, you can see you got a low and then a lower low on the price action. And on the histogram, you have a low and then a higher low. So there's another disagreement. MACD swings, you have a low and then a higher low. Then you had very close to oversold levels. And this is a 2-day chart, right? So a 2-day chart with oversold conditions with a bullish divergence. That's really the key to a really good trade. You might not see them all the time, but it'll also limit you to how often you're trading. And in trading, you really don't want to start over trading, meaning you don't want to be in a trade too often or getting too eager to be in a trade. That can be one of the biggest downfalls for most beginners. It's just always thinking they need to be in a trade all the time. So if this was part of your strategy, it would teach you some patience, right? Because you're only waiting for a certain signal before you're entering into a trade. And these can be some of your safest trades, right? So potentially you could be sitting on the sidelines for weeks, maybe months in some cases, depending on the time frame that you're charting, right? So this is a 2-day chart. You're not really going to see these divergences happening all the time, right? Not every day, maybe not every week, might even take a couple of months. Okay, so it's important to remember, if you're using the higher time frames, you're looking for bigger moves to the upside. This divergence popped up in this green square. And then we're going to look over here on this bigger square, which is really just the 2-hour zoomed in to this section on the 2-day chart over here. On the 2-day chart, you had one divergence on the histogram, you had another one on the MACD, and then you had basically oversold conditions on the 2-day chart. Oversold again with bullish divergence. That's a solid technical indicator for when the chart could reverse in the opposite direction. As you can see here, we got a big move out of SHIB. So now we'll look at the right side chart on the 2-hour. What would you have done to enter into this trade? Now what I would be looking for is, now that you've acknowledged on the higher time frames that you have this big bullish divergence going on and you have some confluence across a couple of the indicators, right? Your MACD and your histogram and the oversold conditions on the 2-day. How would you enter into this trade? Right, so I come over here and I zoom in and I look at the 2-hour chart. Now again, like I was saying, you acknowledge that you have this divergence going on. So if you trust that the divergence is ready to play out, you start looking on the lower time frames and you're trying to find an entry. Over here on the RSI, it came all the way down to oversold. This is where I would have tried to enter into this trade, trying to catch maybe not this bottom necessarily, but after it bounced and came up, and this first little higher low. I'm going to expand this circle a bit. Okay, so you can see this higher low is higher than this low. This is where I would have started accumulating my entry for this trade. Okay, so you got oversold conditions on the 2-hour, and you know that on the higher time frames, you have a very bullish idea that could be ready to play out. So after you see this low come in, and you have oversold conditions, I'd be looking for the next bounce to be at least a higher low than this low. That's a really good indication that the trend could be changing direction. We're going to go over that in another video where I explain higher lows and higher highs and how they can change the direction of the trend. You have the oversold conditions, and you're trying to enter into this trade trusting that the higher time frame divergence is ready to play out. Next chart we're going to look at is DYDX. Now again, we're just looking at divergences for the most part here. Now I'm just giving you an idea here of how much of a move you can expect when you're using at least the 1-day time frame, right? So a 4-hour chart, that's going to be pretty decent for a divergence as well. You might expect maybe a 20 to 30, maybe 40% moves. On the 1-day chart, you can get numbers like 151% to 126%. 62% on the other side over here. So again, we're just looking at the divergences only. And if you wanted to front run these ideas, you can trade these just for short-term trades and just trade the divergences. So maybe you're in the trade for a couple of days, maybe it's up to a week or two, and then you're out of the trade and waiting for the next signal, right? So over here, you had bullish divergence. And once the price came up here, you can see it was overbought, right? Overbought RSI. So that would be your entry, your exit for that trade. You've captured this move, you took a chunk of this 62% move to the upside, and then you exit, and then you're waiting, right? You wait for the same opportunity to show up down the road. So then a couple weeks later in May, you had another divergence show up, right? So here the RSI has got a low, and it's printing a higher low. On the price action, you have a low, and it's printing a lower low. So you could have front ran that idea and jumped into this lower low with the divergence. Traded again all the way up to the top. Once you got near the overbought levels, this is where you consider taking your profits and exiting your trade. And again, you're just waiting for the same opportunity. And then sure enough, down the road, you had another bullish divergence pop up. Here's your low. Price action kept making lows. Here you had a low, and then you started making higher lows, also in oversold territory. This one might have been a little harder to catch because you had a bunch of different moves, a lot of little swings in here. So this is where your trend lines would come in handy, right? You'd essentially have this one put down. You'd be trying to catch an entry on this support level. If you had that divergence and you're coming down close to support, you're just trying to get an order filled close to that support level and then counting on the divergence to change the trend. If you had entered on this divergence close to the support area, you'd be coming all the way up to here. This is a 126% move. And again, once you got up to those overbought conditions, you exit the trade and then wait for the same scenario to happen again. Okay, the next chart we're going to look at is AVAX. Okay, so the same ideas we looked at for DYDX. You had a bullish divergence here, you had your low, a lower low, and the RSI gave you a low and then a higher low. And that move ended up being a 57% move, and this is a 4-hour chart, so it's not quite as big as the DYDX, which is the daily chart. It's the 1-day DYDX. AVAX, this is the 4-hour. So really the time frames that you're using are going to be relative to the size of the move you get. Not necessarily set in stone rule, but it's a basic guide that you can go by, right? Expect a bigger move on higher time frames. If you're using a lower time frame, don't expect big, huge moonshot moves. Okay, so again, you would have entered on this divergence, right? On that higher low. This is printing a lower low. Also oversold with bullish divergence. Ride that up, went to overbought conditions. This is where you exit the trade, you take your profits, and you wait for the next opportunity that looks just like this, right? Then you had another hidden bullish divergence over here, where you had oversold conditions. Now this was a low, then a lower low, and this was a low and a higher low. So this is a hidden bullish divergence. This can be a little tricky and a little confusing, but after a while you'll start to understand. It's basically, like I said in the beginning of the video, it's just a disagreement between the indicators and the price action. So over here, low, a higher low on the RSI, and you had a low and a lower low on the price action. Hidden bullish divergence is a low on the price action, a higher low on the price action, with a low on the RSI, a lower low on the RSI. That makes a hidden bullish divergence. So again, if you were to trade this idea, you would have had about a 56% move. Once it got to that overbought territory, you take your profits, you close your trade, and you wait for the next opportunity. Okay, this last chart we're going to look at, this is the Bitcoin 1-month chart. So we're looking for confluence of ideas here, right? So if you're using a monthly chart, we're looking for a big move. Potentially these aren't just scalp trades, right? Or day trades in any way. These are epic bull runs, right? So the higher time frames that you're using, you're expecting longer duration of that trend to continue. So over here, I've drawn a trend line on the RSI. And you can draw patterns on the RSI. Most people will only trade if they can see patterns on the RSI as opposed to the price action. But really, you're just looking for confluence. So all of these purple circles is where you had touches on the trend line, right? One touch over here, another touch over here, another touch over here, and one more at the end. This is really close to where we are right now. We're expecting that if this trend line does what it's done before. Every time you had a bounce, bull run. Right? Had a bounce here, bull run. Had a bounce over here, bull run. Another bounce over here, maybe we were starting another bull run, right? So we're looking at the RSI and we're combining it with the Stoch RSI. So the Stoch is oversold. Now I don't like using the Stoch on very low time frames because you get a lot of noise. So I prefer to use them on the higher time frame charts. And again, I'm just looking for confluence between the indicators and the price action, maybe divergences on the other charts that I've shown you earlier. And then we're really just looking at the oversold conditions is the yellow boxes. You have 4 yellow boxes, we got 4 purple circles. So these 4 purple circles basically line up with the move that's coming on the yellow boxes, right? So the Stoch RSI is very quick moving. This was oversold. We had a huge bull run that followed. So the RSI over here had a bounce on this trend line. And then with confluence, you can see the Stoch RSI leaving oversold conditions. And that was a nice little bull run. Same thing over here, you had a purple circle, then this yellow box for the Stoch where it was leaving oversold conditions. This was another bull run. Over here again, you have the purple circle on the trend line touch, and you have the oversold Stoch leaving oversold conditions. That was your next bull run. Over here at the end, we're seeing the same thing that we've seen previously in Bitcoin's history. Right? So you have a purple circle here, and you have a yellow box where it's leaving oversold conditions on the Stoch RSI once again. These red lines, by the way, are all halving dates. But yeah, that basically wraps up this video. Just trying to give you a little more insight on how to read the price action and compare it to the indicators, how you can apply them to a chart to find entries. And really, you're just looking for safe trade opportunities and you're trying to limit yourself from overtrading. Overtrading can be a killer and it can destroy your portfolio. So don't always feel that you need to be in a trade all the time.